Welcome. This is the Lifetime Cash Flow Through Real Estate Investing podcast. This is where you'll learn strategies to help you achieve lifetime financial freedom through real estate investment. Your host, Rod Khleif, has owned over 2,000 homes and apartments, and he brings experts in all aspects of real estate investment and management onto the show. Now, here's your host, Rod Khleif.
Welcome to Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I'm thrilled you're here. Before we get to our awesome guest, I want to mention one thing, and that is, if you like what you hear on the show, make sure you subscribe to us on iTunes so you never miss another episode. All right, let's get this party started. I know you're going to get incredible value from the guy we're talking to today. His name's Ryan Dunigan. He's a very successful real estate investor. He has done a lot of syndication, I believe in Phoenix. We'll confirm that. He currently owns over 245 units and some commercial properties, and altogether valued over $17 million. And I think he has a tremendous amount of value to add to us today. Ryan, thanks for being on the show, buddy.
Thanks for having me on, Rod. I really appreciate it. I'm thrilled to be here.
Awesome. So, I guess the first question is, who's Ryan? Tell us your story. How'd you get started, and how'd you get where you're at right now?
It's a good question. I started out actually on the brokerage side in real estate, mostly investment sales in Southern California. So I worked for a broker team that sold office buildings and industrial buildings and lab buildings, and I did that for 6 or 7 years, and I learned just a ton. I learned all about discounting cash flows and numbers and the power of networking, building relationships. But I just came to the conclusion that brokerage just wasn't for me. I didn't necessarily get the sense I was building a lot of value and wealth for me and my family for the future. So I wanted to transition to owning my own real estate, and I slowly did that over time on nights and weekends while I had my day job. So that's really how I got my start. My father was in real estate when I was growing up, so I had some exposure to it, although not necessarily on the personal side. So that's really where I got my direction from, and I.
So let me stop you. So you had a full-time job. And was it the broker job, or was it something else? Did you move on past that, the broker job, and do something else for a while?
Nope, I had the full-time broker job, and I transitioned over to an asset management job within the brokerage operation, solely planning on doing this on the side. And really my whole goal was to take this institutional quality real estate and the processes that they had and bring it down to the mom and pop and the Class C multifamily properties, and really apply a sense of sophistication that you get in the institutional world to the personal real estate world. And that was really my goal and what I was doing behind the scenes. And it took me a couple years to fully make the leap from doing that and moving over to the real estate investing world.
So you were doing it nights and weekends. Give me an idea of the things you were doing. I mean, obviously you were getting an education just from the position that you were in. So you're out there kicking the tires, looking at deals. Is that what you were doing?
Yeah. It took me a couple years. I was living in San Diego, and I still am, but that's not the best market for cash flow in real estate. So I looked outside. And I settled on Phoenix. I wanted to be relatively close, but didn't need to be in my own backyard. So in 2012, I did my first syndication deal where, I had gotten to know the market over time and the brokers over time, and started to build a team with property managers and contractors, things like that. And I actually did a deal, it was a 21-unit property that I syndicated while I was working for the brokerage arm. So lots of late nights, lots of weekend trips out there, and lots of education before I did any act.
So you guys are hearing this, okay? He started this thing with a full-time job. Now, again, he had the educational component because you were a commercial broker, but that's not to say none of you listening couldn't do the same thing and educate yourselves, through a course or through books, and supplement that with these podcasts. But you actually started this thing on the side. You had a day job, and You talked about a couple things that I want to expand on a little, Ryan, because you hit some buzzwords for me. One of them was that you said you learned about networking and building relationships with the commercial brokerage. Expand on that a little bit. Tell me some of the things that you might suggest to a aspiring real estate investor in that vein.
Yeah, I'd say, a lot of it was relationships that you built. You got a deal because you had a good relationship and you treated people well over time, and you established that trust with people. And that goes across the spectrum depending on what part of real estate that you're in. But I consider that one of my strengths. I've always focused on networking and getting educated, and this podcast is fantastic. I would read books. I would go to the meetup groups, cash flow games, RIAs, anything where I could network and get around some smart people and learn what I could from them and add to the conversation whatever I could with my own experience. And if it was just referring anybody that they're looking for to them, went out and got a mentor.
Okay, no, wait a minute. So if they're there and they have a need, you did what you could to help them fill that need. So you're adding value to them as well.
Yeah, that would always be one of my first or last questions is how can I help you out? And if somebody needed to, they needed to get a loan and they needed to talk to a finance guy within a particular market and I knew somebody, I would connect those two dots. Property management.
Fantastic. That's fantastic. And the message there is, even in these groups, that what Ryan did and probably still does is very, very powerful. But also when you're looking for a mentor, don't just be a taker. Make sure you do what you can to give as well and help, add value to whoever, you ask to help mentor you in this business. So, okay, fantastic. And then you talked about putting a team together. Let's expand on that a little bit. So you went to Phoenix, you did your first, you started, did you put the team together once you found the property or did you do it ahead of time?
It was a parallel track. I had started beforehand, specifically with the brokers. I would go out and meet with the top 3 or 4 brokers and the units, 100 units and less. And I would get to know them in relationships so they knew what I was looking for. So if they came across it, I would at least get a call. Being new to the market, I hadn't proven myself yet. So I started laying down some of the groundwork. And then when we did get the first deal, then I really started hitting it hard and finding the right property manager. And I did not find the right property manager, and we can get into that if you'd like.
No, we will. But let's keep going on your team first. Mm-hmm.
Sure. So property manager, the big one for me was the broker, and then another vital component of my team, because we do a lot of value add work, is the contractor. Mm-hmm. Right. So the repairs and maintenance and the renovations and finding somebody that you can trust for the long term. So it was really a process, and it took a good 2 to 3 years to develop the team to the point where I felt comfortable.
To get to the team you were good with.
Right.
I'm sure you went through some people. Right. Okay. And so how about a real estate attorney? Did you find one out there, or did you use one in California, or how did you write your contracts?
Yeah, I actually found one in California that I had worked with previously, and I'm involved in the CCIM program, and he happened to be an instructor for that program. So he came with a lot of trust, and he did great work.
Are you a CCIM?
I've gone through all the classes, and I haven't, it was right at the time when I was leaving my full-time job as a broker, and I haven't completed the process, but I've taken all the classes.
Well, those of you listening, CCIM, my brother has that designation. It's not an easy designation to get, and I will tell you that when you're dealing with brokers, if they have that acronym behind their name, they know their stuff, okay? They know how to analyze a deal. It's a lot of numbers. It means, Ryan, that you're probably analytical, and because I know my brother sure is. He's an engineer in a previous life. So CCIM is a great designation of behind a broker if you want to work with a top broker. Well, congratulations on that, and good luck with getting that designation. Okay, let's hear about your now on the contractor side, because this is good for these guys to hear. On the contractor side, did you end up going through more than one contractor, or did you get lucky on the first shot?
We actually found him through our first property manager, who that did not end up working out, and since then, yes, we've stick with him. It's been a 6-year relationship now, and it's gone very well. There's no perfect relationship with the contractor that I've come across. There's some give and take, and we've had our trials and tribulations, but we trust each other, and we work through the issues when they pop up. And he's a key member of the team. When I go out and raise capital, I need to know that he's going to perform on the back end, and that my contractors can perform at the back end.
And for the prices that you've allocated in your prospectus, so that you don't have any surprises. Yeah, no, I get it, and that's why I'm surprised. And you're very lucky in that regard, guys, because that's one area that can be challenging, particularly contractors and property managers. But I usually hear more about it with contractors. So you got very lucky. So let's talk about your property manager debacle.
Yeah. So here I am. I'm an out-of-state California investor buying in Arizona. So I've got a big target on my back. I'm not the smart money. We would have...
let me interrupt you for 1 second, because I don't want to lose this thought. I apologize, Ryan. But you said something earlier that I want to make sure the guys heard. You live in San Diego, but you wanted to invest close enough, and so you picked Phoenix, which is, it's not a long drive from San Diego. So, guys, if you're in a market like Miami or Chicago, or not Chicago, no, I'm not going to use Chicago. Let's say New York, Miami, L.A., it's okay to drive a couple hours to pick a market, or even 3 hours to pick a market. And we go even as far as 4 hours. But as long as you can do day travel, you can make it work. So I just wanted to highlight that, because what you did was brilliant. You got out of the high dollar area that you're in, and you found a market, and then you found a sub market within that market, which I want to talk about as well, which is the Hispanic thing that I saw in your prospectus. So we were talking about the property manager. Forgive me.
No, that's quite all right. And just take a quick step back. I kind of look at myself as a bridge to cash flow. A lot of my relationships are in Southern California, and there's not a lot of cash flow due to the price and the rent ratio. So that's one of my value propositions to the people that I invest with is, hey, I know this market well. I've invested many years of my time, and I actually continue to go out there every month for 7 to 10 days just to keep my finger on the pulse of the market and maintain the relationships that I've built out there. So that's another positive that I can bring up with.
No, I like that. I like that term too, bridge to cash flow. And those of you that are in high dollar areas like I am here in Sarasota and LA, San Diego, New York, Miami, there's a lot of money there. And that's a great elevator pitch for potential investors is being outside that market in a second tier city, a smaller market, and using that pitch. I love that.
Yeah.
Okay. Right. So property manager.
So the property manager. So the first one, did my homework, looked online, spoke to some people, and hired them. And a lot of property managers
large company, small company. Did they manage other properties like the ones you were taking down?
Yes, it's a nationwide company, and they've got local franchisees across the nation. So, and an air conditioner would go out and it would leak, and they'd have to cut open the drywall and drain the drain pan and fix that, and I would get a bill for $1,700. And I'm not the smartest guy in the world when it comes to the nitty gritty on the improvement stuff, but I know what I'm taking advantage of. So I said, all right, we've got a problem here. And we tried another one, and I just couldn't get comfortable finding a good, solid property manager that had their interests aligned with mine. They would make money on a vacancy because there was a lease-up fee, and then they would do all the maintenance to turn the unit, and they'd get their markup on that.
Which is also a big profit center. Yeah, the maintenance is a huge profit center, guys. And whenever you're dealing, those of you that listen to my podcast know I advocate for self-management. But whenever you're dealing with a property management company, if you decide to go that route, I mean, as you've heard me say before, you've got to manage that property manager, and particularly in the area of maintenance. And, ideally, if you buy a large enough property, or if you've got enough infrastructure, like I think you do, Ryan, with multiple, 8 to 12 unit buildings, you can hire a full-time maintenance person yourself. But then you've got to cut the deal with the management company that, hey, you're going to call my maintenance guy. You're not going to send your maintenance guy at $50, $75 an hour. You're going to use mine. So that's one solution. But So they got you on lease ups, and that's another way they can screw you guys is, let the property go vacant, because they typically charge a lease fee, half to a full month's rent to lease the property, over and above the monthly management fee. So anyway, I'd like to interject and explain some of these things sometimes, Ryan. So forgive me for doing that. But
no, I appreciate that. I really think that the difference between good cash flow and not cash flow is the property management. So I had the situation, and that was how do I handle this from 400 miles away, and ended up essentially doing what you recommend, Rod, and that's self-managing the property. So I brought in a longtime friend and partner of mine who had been an investor on a smaller piece of the smaller deals that we had done, and he expressed some interest in earning some more money on the side, and he eventually quit his job and did the property management for us. And so he's a part owner and a property manager. And I essentially went out and got my broker license in Arizona so that he can manage all of the... Sure,
underneath your broker license. Good for you. Yeah. So two things I want to expand on there. One is hopefully you guys heard that. So Ryan gave him a piece of these properties. So do you think he's motivated to keep the expenses down, the income up, and take care of those properties? The answer would be yes. And the component of needing to be under a broker, because even though Ryan owns a piece of all these properties, because there's other people involved, for a property manager to manage them, they have to be licensed. And so that's why you set up the brokerage, and that's why I've told people on my podcast, I typically own a real estate company in any market that I spend a lot of time in. Like I have one here in Florida, and I cut a deal with a broker, and it's a good deal for him. It's a good deal for me, but not just on the it's great when I'm listing property or looking for property, but it also comes into play in this component where you're trying to manage properties that you've syndicated or even manage for other people, for that matter. And I think you manage for other people as well, correct?
Yeah, we actually branched out and we manage about 60 units for some investors that I developed a relationship here in Southern California, and they were just more comfortable in owning their own properties outright as opposed to being a part of a syndication. And that was great. So I helped them, and I guided them along the process and helped them with the financing, and we handle their property management for them now too, just as if they're our own. So I think it was really a true win-win for everybody.
So, let's pull back for a minute and talk about. Well, let's talk about your first multifamily deal. Let's get into some specifics. Your first multifamily syndicated deal. So, how many units was it?
21 units.
21 units, and what was the price?
It was $800,000 on the nose.
Okay, and what was the plan with the property?
It was 90%. This was 2012. It was about 4 years ago. And I had just come off of a syndication workshop, and I was all jazzed up, and I found it the Tuesday after.
Was it the real estate guys?
It was the real estate guys.
Yeah, I went to that one in Phoenix. I may have been at the same one you were at, actually. No, 16. Yeah, I may have been to the same one you were at. My wife and I think were at that. Anyway, I digress. So you went to the syndication boot camp.
Went to the boot camp. I learned all the legal stuff I needed to do when I brought in other people's money, and I got excited about it, and I went for it, went out and found a property, and it turned out to be a nice one. So it was 90% occupied. The existing owners they were managing it strictly for cash flow, and they stopped reinvesting in the property. They had bought it near the peak of the market, so it didn't have a lot of excess.
So if it was 90% occupied, what was the upside?
The upside was in rents and some deferred maintenance. The average rent there was $500 a month. And I knew that we could bump that up after I did all my education on the market, and I had owned some smaller stuff, and I knew that we could get over $600 a month. So, and this property was uniquely laid out physically that the back of each unit was about 8 feet from the block wall perimeter. And so we just installed some privacy fences, and everybody got their own patio.
Little backyard. Wow. Okay.
Yeah,
or patio, really. Yeah. Okay.
Just a little thing like that. And then
that's huge, though. They can throw a grill out there. They can throw their bikes out there. That's huge in an apartment community. So fantastic. Great idea.
And their storage, so everything that they were storing in their front went to the back, and it just improved the perceived look of the property as well.
Oh, sure, because otherwise all their stuff's out front where you see it, and it looks like hell. So that was a double win-win. Good.
Right. And in that particular market, that there's a value of about $35 a month for a private backyard. So in addition to putting in hard floors and cleaning up the property, they got patios. And then we had the tailwind of the market at our back and an improving multifamily market. And now our average rents are in the $670 a month range. And we're fortunate. I'm looking at refinancing the deal to unlock some of that equity and return 30 to 40% of everybody's initial capital back, and we will continue to own the property long term, and we'll get all the tax benefits going forward. So
fantastic. Yeah, no, that's the way I love to do deals as well. So tell me what happened value wise. I think you said, was it $800,000 on the purchase?
Correct. It was $800,000 on the purchase, and we probably put.
And you probably compressed the cap rate as well by cleaning it up.
Yes, we sure did. I'm waiting on the appraisal, but I've internally valued it at $1.4 million, and we did put about $100,000 in capital into it. So,
so you had $900 in it, so you've got $500,000 in equity that you've created.
Right.
Better than a sharp stick in the eye.
Right.
Awesome. Good work. And that's just a 20 unit, guys. That's just a 20. What did you say? 22?
21 units.
21 unit building, create $500,000 in equity. So that's what's possible with these smaller apartment buildings, guys. So that's very impressive. So tell me, let's talk about how you took it down. So you found the building. It was stabilized. Stabilized, guys, means you're at least 80% occupied. So that makes financing much easier to get. So it was stabilized. And what, did you just go out to a regional bank and get financing?
That's all it was, just a standard 65% loan to value, because, again, it was stabilized, lower rent. Yeah,
but 65 is still really low. You know, I hear people are getting 75, 80 now. Why do you think it was only 65?
You know, I think, you know, I'm generally fairly conservative right off the bat. So, you know,
that was you set it up that way.
I probably could have got a little bit more aggressive, but wanted to stay conservative. It was my first syndicated deal. I wanted to make sure it was a success for everybody. So I was pretty happy with the 65% loan. I was the personal guarantor on that loan. I didn't want to have any investors involved with the loan at all. Take that risk off of their plate.
No, that's awesome. And guys, just so you understand, it's much safer to have more equity and less debt than the alternative, than the reverse of that. So, you know, if there's a problem, you know, equity can wait for their money, but debt can't. So, you know, and typically, even if there's a dip or a problem, things will come back around and the equity will come back. But again, so that was a conservative, very prudent, and very smart way to do it. So, good. Okay, so you had to put together, let's see, 800,000 times 0.4, so $320,000. And did you have to also raise? Did you charge a syndication fee?
Well, and then I also set aside another $100,000 to execute
for the repairs
on the repairs and the capital. Correct. So it was about a $440,000 raise, something in that ballpark.
440. Okay. All right. And how'd you do it? How'd you go out and get it? From your networking?
It was all 100% from my networking. And prior to that, I had done some duplexes and some fourplexes, and they had gone well. And I just shared the results with my immediate network of friends and family. And this was when the stock market wasn't doing very well, and I let them know what types of returns and all the benefits that we all know about cash flowing real estate, what those are and what those mean to them, particularly in California, where most people are in a higher tax bracket. And they just let me know, hey, next time you got a deal, let me know. I'd love to participate. So I just collected that over years, and then I put together a little business plan and put together an offering memorandum and went to my real estate attorney and got everything all buttoned up and And then I presented it in an email and sent it out to everybody that I had a relationship with, and
that was the operative term right there, guys. Had a relationship with you with a syndication. You have to have a prior relationship. So anyway, I apologize. Just wanted to throw that in. So you sent it out to your list of people that you had an established relationship with.
Right.
And
that's
from
very
there.
important. It wasn't just, hey, I found a deal and I put out an email to everybody that I knew. I had been fostering and nurturing those relationships for years, so that when it was time, it was a easier process versus scrambling and not sure that I could raise the equity. I was 80% confident that I could raise the $450,000, and that was enough for me to pull the trigger, and so I did, and it took about 6 to 7 days to fulfill those equity commitments, and I set a minimum at $25,000 to attract as many people as I could. And went forward from there.
Fantastic. Now, this is always a little uncomfortable to talk about, but I want to bring it up. You can also, and I know you charge, and most people do, charge a syndication fee, and it's only fair. You're the one putting the deal together. You're the one out there doing the due diligence, paying for the third-party reports that sometimes you spend the money and you don't get back if you back out of a deal. So you can charge a syndication fee, which is you for putting the deal together. And give me an idea of what you typically charge.
Every deal is different, and it'll range. This particular deal, I want to say it was about 2% of the purchase price. I've got my purchase price.
So that's very low, but that's great. I hope you're charging more than that now, because frankly, it's worth it for the value that you bring to your investors.
It was low. I didn't realize what value that I was bringing, but I really wanted to do this for experience. I really wanted.
Oh, sure. And most of you are probably going to do that on your first one. It'll be low because you don't know. It's also sometimes you'll get people that'll push back on it, investors that'll push back on that, but you have to be strong on that, because you're bringing so much to the table. I mean, you're out there hunting for these deals, and you'll look at 100 or 200 sometimes before you find a deal, maybe even more than that. So, you're entitled to something for that. And so, I've seen them as high as 5%. I think the average is probably 3 to 4%, but it could be 5%.
And that was really my thought process was, okay, I'm going to bring these people on board and do well for them and grow this over time. I consider it's going to be a very long career of investing. And again, I had a job on the side, so I didn't necessarily need to maximize the fee dollars on the first deal. And it was really just to deepen the existing relationships and to find good, solid partners for the future, because this is going to be a long haul here. So that was really my mentality.
No, that's smart. That's smart for the first deal. Now, let's talk about other ways that you can add value and benefit through fees. Now, obviously, there's a syndication fee. Do you charge a fee for being on the debt, or is that included in the syndication fee?
That was all included in the syndication fee. Sometimes we will charge a real small asset management fee, and that's really pegged to the net operating income. So I'm incentivized to keep the revenue high and the expenses low. We're all on the same page there. And at any time, the investors have the right to vote me out as manager. And I think it's important to have some small compensation in place if somebody else were to step into my shoes.
That's smart. Okay, I see the value of that. Not from the negative side, but let's say you get hit by a truck, that somebody can come in and there's some fees available for that oversight. That makes complete sense. Now, what about? I assume that now that you've got your own management company, that's another way that you can add value to the syndication and the partnership, and also collect a management fee. Correct?
Correct. Yeah, absolutely. Right. So it's actually, we've priced it a little bit lower than the market, and I know that it's a much better service than the market. So that's actually a positive thing that I bring up with people, and I'm up.
Well, that's a sales point. Yeah, that's a sales point for sure. Both those things. I mean, you're the one managing it. You've got a vested interest in it. That's kind of a no-brainer, and you certainly should get paid for that work. So, Okay. All right. Well, as you were doing this, did you have any mentors?
I suppose you could call the real estate guys mentors. I was listening to their podcast at the time and sucking up all that knowledge that I could and reading books. But there was one guy that actually here in San Diego that was also investing in Phoenix, and I would call him from time to time and bounce some ideas off of him. But the relationship didn't go much farther than that. But I was just motivated. I knew what I wanted to do, and I made sure I was educated before I did anything, and actually did smaller deals specific just on my own dollar to make sure that I would learn on my own dime, not somebody else's. So I felt pretty well prepared by the time that I went out asking for other people's money. So to answer your question,
it's funny. I just interviewed Russell Gray a few days ago, and it was a very high level, complex. He's one of the real estate guys for you guys that are listening. There's two of them. I forgot the other gentleman's name right off the top of my head, but there you go, Robert Helms. They're a great duo. They've got a great podcast, and if you really want to drink through a fire hose on doing syndications properly, they've got a great boot camp on that. But Russell is an economist, and it was a very high level conversation, macroeconomics, and it was I'm debating. I'm debating when to put it out, but anyway, that was an aside. But good guys. So
he's fantastic, and since then I've actually went and I did hire a mentor. His name is Jay Massey, and I think Rod, you've been on his podcast in the past. And,
Jay's awesome.
Yeah, so he's been instrumental in helping me kind of fine tune the process and help build my own internal team in terms of getting help, in terms of not doing my own books and really focusing on the high value add activities, which in my opinion are networking, relationships, raising the money, and finding the properties. Anything beyond that,
go.
I'm really learning that there is somebody out there willing to do the work. You don't have
better
to do
than
it
you
all.
can.
Better
than you can.
Right.
Absolutely. Yeah. No, I actually own a. This is an aside. I've never even said this publicly, but I own a remote bookkeeping service, Affordable Bookkeepers, and we provide bookkeeping services for a fraction of what you can hire a bookkeeper for, and it's just kind of a no-brainer. And we can do a better job than typically most people. So, anything that you can leverage so that you can focus on your core competencies, like you just described: networking, raising money, finding deals, and strategizing to put those deals together. That's where you need to be focusing, not doing something that you can pay somebody to do. So totally agree. And whenever you can leverage anything, you should. So let me ask you a kind of a general question. What suggestions would you have for someone starting out in this multifamily real estate investing game?
Oh gosh, I would say first thing is get educated, and this podcast is perfect. Read all the books that you can. Again, go to some meetups and some real estate events, and really just talk to people. Let them know what you're doing, what your background is, and what you would like to do. And you just never know who can help you and who you can help. And then I would say going out and taking a look at markets that interest you and really narrow it down to one or two, and then go deep into those markets and really learn what part of the markets that might work for your business plan and what you'd like to accomplish over time. I would also say you should do the same with possible investors, and really I think what's important is matching your property and your business plan to your investors. You don't want to have quick money and guys that want to do fix and flips into your 10-year long-term hold deal. That's just asking for
it's a totally different investor. Same thing with where you are. In California, the investors that invest in startups in Silicon Valley are not your investors. Those guys are looking for the big hit when the IPO happens or additional funding happens. You want somebody that's looking for cash flow, and that's why the name of this podcast is Lifetime Cash Flow. I mean, that's those are your investors, and that's why it's so important, guys, to make sure that you find out what your prospective investors are looking for. You need to make sure that you ask the questions, because that's how you'll determine, who's a good fit and who's not. Don't go right into telling them about your deal. Find out what they're looking to do with their investment capital and what their plan is, and then you'll know who to approach and who not to approach.
That's an excellent way to put it. And right now there is a lot of capital out there, and there's very few good, solid deals. And there's a lot of people that are looking for yield and return, and they don't trust the stock market, and they're getting nothing in their bank account, and bonds aren't paying anything. So, if you can articulate the benefits of cash flowing real estate and what that can do to help somebody else out, you're going to have the
tax benefits,
right?
By the way, and the tax benefits, huge, because sometimes you'll find investors like doctors and things of that nature, where they have really high Schedule C income, and they're getting killed. And if you can, and by the way, and I think I've mentioned this before, you can carve up the tax benefits where certain investors get a higher percentage of those deductions. And you can do advanced strategies like cost segregation, which I really need to do a segment on, where you accelerate the depreciation, which is just unbelievable. I don't know. Have you ever done that, Ryan?
I've looked at it, but my deals were a little on the small side to make sense.
Oh, I disagree, buddy. I disagree. I respectfully, 20 unit, you could definitely cost seg. You could go in there and cost seg that thing right now, and you'd be astounded at what it does to your next few years' depreciation. But that's a topic for another day. But those are the things that when you're finding out what your investor needs, if it's cash flow, if it's tax benefits, do they need their payments monthly? Is quarterly okay? All these types of things that you've got to find out so that you make sure you're a good fit. So
I couldn't agree more. There's a lot of people that are in that 40% tax bracket, and you can carve it up and you can help them out. And if you find another investor that's really only needs cash flow, you could segment that deal, and you can really help out two investors with the same deal.
Exactly. So every week I put out like this 5 to 10 minute episode called Your Driving Force Success Tip. We talk about goal setting, visualization, motivation, things like that. So I regularly like to ask my guests where you get your drive. What makes you jump out of bed and do the business that you're doing. It keeps you motivated.
Well, I had a daughter about a year and a half ago, and
congratulations!
Literally
awesome.
Gets me out of bed every morning earlier than I want to get out of bed. but that's a very big part in building long-term wealth and cash flow for my family, for everybody that's important to me, friends, family. I really think that I put in the time to learn this, and I want to be able to use what I've learned and apply it and help other people. I really do get a kick out of that. You should see the smile on my face every month, every quarter when I'm sending out distribution checks, and it really does make me feel good to know that I'm helping people that I care about. So that
sure,
that's it.
Okay, fantastic. So last thing, we're getting near the end of our show here. I'd like you to share, I'm going to ask a different question. If you could go back, knowing what you know now, and go back to when you first started, what would you tell that person, 5-6 years ago, to exponentially maybe grow bigger or avoid mistakes or whatever? What advice would you give your younger self?
I would say that I probably would have gotten a mentor earlier, and I would have taken action earlier. As you mentioned, I'm actually pretty big on the analysis side, and I got a little bit of paralysis by doing so. And I think if I had a mentor that had been through the same process and done the same things that I was looking to do, I think I could have accelerated that, compressed that time frame a little bit more. And then I would also build a team around myself sooner than I did. I'm still in the process of doing that after all these years. And I think had I done that earlier, I really would have accelerated the trajectory of the growth and been able to take advantage of the market and really the team that I built sooner than than I have now.
It's funny. I almost hear that same answer almost every time I ask it, which is I wish I would have started quicker. I mean, a version of it, a version of that answer. So that's very interesting. And I hope you guys that are listening are hearing that. Get started. So, all right. Last thing. Do you have any quotes that are hanging on your wall?
I really like the one. I believe it was Dale Carnegie, and correct me if I'm wrong, but it's if you help enough other people get what they want, you'll get what you want, and I really do.
I actually think that was Zig Ziglar, but I could be wrong. But that's a great quote. Great quote. Yeah, I love that one, and I live by that one as well. Any favorite books that not necessarily just real estate?
I've probably got three that I really enjoy, and I've read a couple times. And the first one is the Purple Bible. It's Rich Dad, Poor Dad, and I read that a little late in life, and that's really what prompted me to want to leave the day job and start building. Sure. I call them little cash flow machines for myself and going forward. Another one is The One Thing by Herb Keller, which really focused on what you need to do and really makes you think and prioritize your short-term goals, your long-term goals.
That's a fantastic book, guys. In fact, we're trying to get him on the show. I'm negotiating with his people right now. He's the guy that started Keller Williams, brilliant guy, and that book is fantastic. And what's the third one, Ryan?
And then there's a third one. It's called The Millionaire Fastlane by MJ DeMarco. And that was one that I read a couple years ago that really kind of lights a fire under you and really makes you want to do more and trust yourself and go out there and do something that other people aren't doing, all the benefits that come along with it. And that it's really a great motivational book that it's very general. I think he started a website for taxi service, but you can really apply it and it really works, and it translates well on the real estate side as well.
I'm going to get that one. I have not heard of that one, so that's fantastic. I appreciate it. Ryan, thanks a million for being on the show, buddy. You've added a ton of value, and really grateful for you giving us your time.
Thanks, Rod. I really appreciate being a part of it, and good luck to you.
All right, thanks. Take care. Bye now.
You too.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please subscribe, and then take a moment to visit iTunes and leave a 5-star rating and review. For more resources to connect with us further, please visit our website at lifetimecashflowpodcast.com. Tune in next week for our next show.